In a time of trade wars, crashing stock markets, recession concerns, investors wander in the dark aimlessly, pleading for someone to save their gains and guide them towards the light, with but one platform rising to meet the call, a beacon to guide us through these uncertain times and answer the most important questions. Where should I put my money? I'm of course talking about TikTok.
Don't keep cash in the bank.
Don't?
No. You should never have money in the bank.
Welcome to The Plain Bagel. My name's Richard Coffin. We're back again reviewing some finance TikToks in episode 9, I want to say, of Investment Analyst Reviews Investment TikToks. It's been a minute since we last reviewed some finance TikToks, and with there being a lot going on in terms of the global breakdown of trade relations, I figured what better time than to look for some answers online and information and advice on what people should be doing with their money during this turbulent time. Now, in the past, I know I've given my feedback on these TikToks, having worked in the industry. For those new to the channel, I'm a registered portfolio manager with my CFA and CFP designations, but I figured this time around, with these uncertain times, let's take on the role of student. I have my handy dandy Microsoft Word document here. We're going to take notes and see what lessons we can garner from these TikToks in terms of what to do with our money during these uncertain times. And I'll probably still comment on a few things, but we'll keep an open mind, see what we can take away here. But without further ado, let's hop into it.
Holy shit, okay? If you are not aware right now, 2025 is about to have so many new millionaires, and it could be you if you know what you're doing and if you take action. In 2024, if you did not learn a high-paying skill, I am so sorry. I know that you feel like, damn, I can't even put into the stock market right now, because for those of us who did learn a high-income skill, we are about to eat, okay? And it's not too late. Hold on, not too late to learn a high-paying skill. I highly recommend that if you're able to, you still do it. But for those of us who have, it is time for us to start buying in the market, okay? This is going to be an amazing 2025.
Ooh, audio was weird at the end there. All right, first note, start buying. Learn high-paying skill. That's about all I got from that one. Yeah, not too much to comment on that one. I'm assuming the high-paying skill is related to a course she might be selling, so be cautious with that. Yeah, no one knows how 2025 is going to pan out, I guess, is kind of the main thing I would want to touch on. Things could go lower from here. They could go higher. You do have to kind of take that longer-term approach, but keeping an open mind here. So we won't comment too much on that one. We'll leave it there.
The stock market is not on sale. Do not buy on these dips. Everything that we have been taught and that we have learned and that goes through all of social media is for up markets only, normal economic times. And right now, this is not an up market, and this is an abnormal economic time. We have to stop believing in these phrases that make no sense. It's not timing the market, it's timing the market. And everything else, throw out the window. 2001, 2002, we had an overvalued stock market, and it crashed, and it pulled the economy down with it. In 2007, 2008, we had a good valued stock market, but the economy crashed and pulled the stock market down with it. Now we have both at the same time. We have an overvalued stock market. The stock market is the second highest valuation in history, going into a recession. That has not happened in my generation. This is going to be bad. So all technical terms and everything of the norm, do not listen to. Go to safety, make sure you're okay, because it's going to be a wild ride. And I do believe the stocks are going to drop 50 to 60%.
Do not buy, only invest in up market. All right, already running into a bit of an issue here. So there are some valid concerns around valuation here, especially given that when you look at the S&P 500, the CAPE ratio is near historical all-time highs, meaning that the gap between stock prices and their underlying earnings is fairly stretched. I don't know if calling it a 2000 plus 2008 sort of situation is fair. 2008 was more of a structural problem that we ran into, whereas this current kind of decline we're experiencing is more event driven. And because of that, we really have no idea how things are going to play out. However, time in the market has proven incredibly difficult to carry out successfully, especially given that oftentimes we see some of the strongest days of market performance following days of very weak market performance. So when you try to sell out before the drop, often that means you're going to miss out on those single day, very strong days of return. And missing just 10 of these individual high return days can dramatically drag down the return you experience as an investor. So it's usually not worth the risk of missing the strong days to try and sidestep what's historically proven to be temporary downturns. And while safe assets might continue to do well, buying into things like gold, for example, after they've appreciated in price means you're paying a premium for these assets. So trying to reconcile the first two TikToks here, you don't want to be overly optimistic. You don't want to be reckless and assume that because we've seen a dip, things are going to bounce back up. There's a chance that things go lower in 2025, possibly even to 2026, given the severity of the trade war we're experiencing. However, if you are taking a long-term approach, you're being diligent with the risk you're taking on. You're not just throwing all your money in meme coins, assuming that over time they'll do well. You're aware of the risks your investments face and say the tariff exposure you have, and you have the risk tolerance to be investing, which is an important one. Then over the long term, you should likely do well by investing, even if you don't perfectly time the bottom. So hopefully that makes sense. We really don't know what the rest of the year is going to look like. So given that we can't predict the short term, it usually makes sense to focus on that longer term. Anyway, let's go back to taking notes here. Just thought I'd add some on these kind of conflicting ones.
Everyone thinks Trump's tariffs are about the trade war with China or Europe, but they're not. They're about crashing the US economy on purpose, and here's why. The US has to refinance $9 trillion in debt by 2026. Most of that was issued when interest rates were near zero. But today, the 10-year Treasury yield is at 4.2%, and every single basis point adds billions in interest over time. So how do you bring yields down? Well, you slow down the economy, even if it hurts. And yes, tariffs usually push inflation up in the short term, but this isn't about the short term. This is about engineering a recession to bring yields down. It's not a trade war, it's a yield war. It's about refinancing America at a discount. So next time you see the headline about the trade war, actually watch the 10-year Treasury yield, because this is where the real story is being written.
Well, if that was a plan, hasn't gone well so far. We've actually seen the 10-year Treasury increase since the trade war kind of onset. So the TikTok is right that the US government needs to refinance a bunch of debt. There is concerns that the average interest rate, or effective interest rate rather, will increase because rates are being reset at a higher level. And it is generally true that during a recession, we see Treasury yields decrease because oftentimes we see investors put their money into treasuries as a safe haven investment to kind of sit on the sidelines and wait for the turbulence to pass. And the action of buying bonds decreases the yield, which lowers interest rates in the economy. Now, I don't know if that was Trump's plan with all this. That's kind of speculation. But there are two things I would sort of poke holes in that if that was the idea. The first being that while a recession might decrease the effective interest rate, it also likely increases how much money the government will have to borrow, because a recession will A, decrease tax revenue. If companies are making less money, that translates into less taxes paid to the government. And B, governments will likely have to spend more for fiscal stimulus. So you're both decreasing how much money you're bringing in, increasing how much money you're outlaying. That difference is made up by borrowing more money. In fact, historically, the biggest jumps we've seen in government debt have been during past recessions and crises. So that's the first thing. I don't know if the benefit of lowering the yield would offset the cost of this additional debt. The second thing is, like I mentioned, if that was a plan, it sort of backfired, given that we've actually seen a sell-off in the Treasury bond market recently. Now, even here, people are speculating as to why people are selling Treasury bonds. Some blame foreign entities selling in retaliation to Trump's tariffs. But there's also the view that investors just aren't treating Treasury bonds as much of a safe haven and view it as being a bit riskier than it's been in the past, given how volatile government policy has been through out all this. And if we see a hit to a government's creditworthiness, it can increase the risk premium that investors demand, which will actually raise yield. And while certainly non-apples to apples comparison, I want to be very clear with that, we can look to Greece for an example of that, where following its sort of financial troubles after 2008, even with a severe drop in its economic activity, we still saw interest rates increase for the country. So I've seen the story before. Maybe that's one of the objectives here, but just kind of some interesting points to add to it.
The biggest mistake a lot of stock market beginners already made with this market drop is buying their stock all at once, oh, the market's down, let me put all my money in now, buy the dip. You never want to buy all your stock all at once because you don't know if the market's going to go up tomorrow or down, up next week, down next week. You want to slowly buy in small quantities, little by little. It's called dollar cost averaging. Buy a little bit each week or each day when the market is down and continue buying. Don't just funnel in your money all at one point. If you put all your money in just because the market was down one day, then what happens the next day when the market dips even more? You have no money left to put in. You should ask yourself at the beginning of the day or when the market's open, is this a buying day? And then put a small percent of your money towards a stock that you wanted to buy when the price is down.
So yeah, dollar cost averaging is a really popular approach for investing, whereby you take the same amount of money, let's say $100 or $500 a month, and you invest it into the market in regular intervals so that you're always buying. And what that does is that if prices fall lower, you end up lowering your cost basis, meaning you're buying more shares for less money, which is generally a good thing if you assume that stock is going to increase in price. And if markets are increasing, you're not sitting on the sidelines, right? You're still buying on the chance that stocks continue to increase. The problem with this comparison is that whether DCAing or lump sum investing is superior depends on where stocks move in the short term, and we don't know what that's going to be, right? In this example, he says, what if you buy a bit today and then stocks fall lower tomorrow? You'll regret not DCAing. But I could flip that argument and say, what if you buy today and then stock prices skyrocket tomorrow? You would regret not lump sum investing. So naturally, the better approach will depend on where markets move, and we can't predict that. And historically, lump sum investing has actually had a better chance of earning you a slightly better return versus dollar cost averaging. The problem is that most people are forced to dollar cost average because you aren't paid your lifetime salary all at once, so you can't lump sum invest your entire life savings. So you have to invest on a recurring basis. Which isn't inherently bad. And in fact, kind of the benefit of dollar cost averaging is the psychological benefit or behavioral benefit of keeping your money invested and following a stringent approach. And that can make it easier to invest because it automates the process. You're more willing to invest during market downturns because it's just part of the process. It sort of removes some of the decision. And generally, you can still do very well with dollar cost averaging. But if you assume that markets are going to increase in the long term and you aren't trying to predict the short term, then lump sum investing actually makes more sense. Now, that's not a guarantee, right? In this current situation, it might prove that dollar cost averaging makes more sense than, say, investing all today if things do fall lower. It's just to highlight that it doesn't inherently make more sense than lump sum investing because it's situation specific, right? It depends on how markets perform. But I'm forgetting my role here. Dollar cost average on buy days. Next TikTok.
You don't pay taxes, a lot of these types of purchases start to become a little bit different.
So you don't pay taxes?
Oh, no, I don't pay any taxes.
Why is that?
This is you, this is your company. Profits in the company create taxes. So what we need to do is eliminate the profit. How you do that is your company creates a holding company and transfers the profit here. This holding company then buys an appreciating asset that you can take loans against. The purpose of the holding company is to make sure that when the loans are taken, it can take care of the company's business expenses, the purchase of business assets, payroll, and all things related to the business. Because we're using loans to then come back out to take care of you, we create no taxes because loans are not taxable. Then the income comes back into the business and we create the entire cycle again, which creates no taxes. So if you still have questions, comment below. Taxes.
Start a company, don't pay taxes. It's crazy how many TikTok videos seem to suggest that you can buy a fancy sports car and then use it as a tax deduction to avoid paying taxes. There might be a situation where, say, you rent a car and use it for a marketing video or something and you expense that amount. The tax authority cares about your expense deductions being reasonable. So if you buy a personal use sports vehicle and then try to claim it as an expense and then you get audited, there's going to be a problem if you can't justify why you needed to buy the sports car for your business. The second thing, while I'm not a US tax expert, putting money through a company before you receive it doesn't eliminate taxes. You would pay taxes here when the company first receives money. The corporation would pay tax on that. And then you would pay taxes here when you receive it personally as income. The tax authority doesn't care that the company took out debt to pay you. There's still a tax liability that comes from that payment. Now, if you're literally taking a loan from your company, something called a shareholder loan, where you intend to pay the amount back and you're paying interest to the company, which is taxable, then while you're borrowing the money, yes, you wouldn't see income tax. But the point is, you can't just eliminate taxes through this complicated structure. You can delay taxes through some methods, and you can deduct actual expenses against your income to reduce your tax liability. But if you're investing your money in an appreciating asset, except for certain situations around depreciation and the like, you're certainly not going to be able to deduct that full cost of that thing you bought. And you'll likely run into issues if you try to deduct any of it if it's appreciating in value, right? Because that would be deemed an investment, not an expense. Now, there are strategies you can use to delay the taxes owed on investments, such as the appreciating asset like the video highlights, by taking a loan against it rather than selling, because if you sell an asset for more than you bought it for, that accrues taxes. So you do see, for example, billionaires borrowing against their investments rather than selling to, again, delay the taxes. They're not eliminating it, they're just delaying the tax until they eventually sell. But then at that point, you have to do the trade-off cost-benefit analysis between the benefit of delaying the tax expense to the real new cost that you're now accruing, which is the interest expense on that loan. And unless you're a billionaire where the vast majority of your wealth is tied up in stock options that you were awarded, decades ago, and you're in the highest tax bracket, it's probably not going to be that beneficial. I mean, if you have questions about taxes, don't leave a comment. Reach out to a professional, someone who can tell you with authority what you can and can't deduct. Because yes, there are benefits if you are incorporated to deducting certain expenses, right? If you take a business trip, it makes sense that you deduct that from your income. So you can see a benefit there. But if you get audited and they find out that you've just been deducting everything and luxury car purchases, there's going to be trouble. I'll add a quick take saying this one might be illegal, but moving on.
So are we just supposed to ignore all these giant dips that happened during President Biden era? Just to paint the picture a little more clear, this is how much we lost during President Biden. Over 20%. This is how much the Dow Jones has crashed as of today. But the difference between this and that is that during Biden was just being Biden. And all these dips happened with no progress in the economy being made for basically the entirety of his presidency. And yes, the stock market is going on a bit of a correction, but this time there's a purpose. President Trump has already stated that this is on purpose. Remember when he said short-term pain for long-term gain? The reason why he put in these tariffs is not just to show the world a lesson and to be fair. Yes, that's a part of it. But the main purpose is to get the money that was exploited by other countries back into the US. For example, this candle. Let's say this candle is made by China, and this candle cost $20. 5 of those dollars stay in the US, and the remaining 15 go to China. Now with these tariffs, this same candle costs $30. But then we have this American-made candle that costs $25. And very obviously, you're going to pay for the candle that costs less. But the difference between buying this $30 candle and this $25 candle is when you buy the cheaper $25 candle, the whole $25 stays in the US economy, causing more money to circulate around. Be honest with yourself. If tariffs are so bad and directly impact the consumer mainly, why do countries care so much? Everybody's losing their mind over this when all this madness was happening, not a word was said.
So look, I don't care about Trump versus Biden. I'm Canadian. I didn't vote for either of them. But one, the dips during Biden's time, there was a reason for it. It was monetary tightening. We were seeing interest rates increase and quantitative tightening. Those are things that generally weigh on the stock market. But two, mainly on the topic of tariffs. Personally, I'm an advocate for free trade, but I'll acknowledge it's a tricky area and countries do have to manage through trade policy to consider consequences, right? For example, things around national defense, things where another country is heavily subsidizing an industry. But a big criticism of all this has been, A, the volatility of it, how quickly things have changed, that reduces faith in the US economy and faith in its ability as a trade partner, and how severe and wide-stretching it's been. One of the criticisms, for example, is that while these tariffs are being presented as a way of bringing jobs back to the United States, for one, it doesn't ensure that 100% of the proceeds a company makes will stay in the US like the poster suggests. If the manufacturer is owned by foreign entities, we'll still likely see those profits sent elsewhere. And two, the US already has an incredibly strong labor market. Yes, it's in different areas other than manufacturing, but these are highly coveted areas like technology and defense, things of that sort. And when you factor in things like reciprocal tariffs, it's unlikely that we see a net benefit from this trade war persisting. It's going to take many, many years for companies to onshore some of their production, assuming that they survive long enough to do so, and households will ultimately bear the costs. The Budget Lab at Yale estimates that households will see an average cost increase of $4,900 a year, or around $2,200 for lower income households, and that gross domestic product growth will decrease. With the World Trade Organization even arguing that global GDP could see a 7% hit from China and the US maintaining its current trade war. And just generally, the mainstream economic view has long been that free trade benefits all parties. And yes, there are considerations. We don't want to oversimplify. We have to consider capital flows. We have to consider employment and things of that sort. But if the US is able to import a commodity for cheaper than what it can make it domestically because of things like specialization and economies of scale, and use its advanced expertise in other areas that it's specialized in to turn those into even more valuable products and services kind of being a big one, then that's not a bad deal per se. And we've also seen historically that isolationism, where country A tries to do everything themselves and B shuts out trade partners, it can be detrimental to an economy. You know, take the candle example. The country is effectively hamstringing artificial intelligence development to make more candles. Time will tell how things turn out, but generally speaking, I do believe the current tariff policy adds more friction than it benefits the US economy. Again, there are issues that need to be addressed. I don't think this is the right approach.
Girl Math is opening a brand new LLC for $200, then applying for $50K 0% interest business funding, then using it to invest in your first Airbnb property for $10K, then paying off the funding with the profits from Airbnb.
Oh, it's a credit card. Oh. I don't know if this checks out. Buy $60,000 Airbnb on credit card, pay off mortgage. I don't know what it is with finance TikToks, but somehow opening a corporation or starting a company is like apparently the finance cheat code. It just solves all your problems. Like, you don't want to pay taxes? Easy. Open a holding company. You want people to start giving you free money? Simple. Start an LLC. You want to buy a $60,000 Airbnb that pays itself off before your 0% promotion ends on your credit card? Buy my course. Either there's an important detail being left out here, or it just isn't true. You're not going to get a property for $60,000 if it's that profitable of an Airbnb. And while there are interest rate promotions you might see like this, they're usually pretty short term. So you'd have to refinance into a mortgage within a few months before you end up paying a 20+% credit card rate. Yeah. We'll end on that one. So kind of forgot to take notes on everything, but here we are. We have our list of takeaways here. I think it was pretty insightful. And, you know, we're kind of poking fun at some stuff here, but as I always try to make a point to highlight, there are some great TikToks out there, some great videos that give you helpful information. You can learn a lot about the basics and the like online. But hopefully this shows there's also a lot of conflicting information and stuff you have to be very cautious about. And if it's going to impact your financial decision, you're better reaching out to a financial advisor who can get to know your situation, your risk tolerance, all that stuff, if you're looking for guidance. Anyway, that's a video. Thanks for joining for another TikTok review video. If you enjoyed it, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on any of the topics we've graciously learned about today. Thanks again for joining, and as always, be safe out there.